What's up, everyone? Welcome to another episode of Market Update featuring by Marketsall and Rationale. In today's video, I'll dig into the details of labor market data that we received last week, all data sets, and the impact of non-farm payroll numbers on market pricings. And I'll review some charts that might explain the current sentiment, current theme of the market. So last week's non-farm payroll numbers came in higher than they expected, which contradict with the previous 2 or 3 non-farm payroll data. And because since the previous non-farm payroll numbers were coming weaker than the expectations, the higher rate hikes were the major topics in last month and but with this data, things might change a bit. And yeah, let's dig into first of all, I just want to cover the data sets, Dataflow quickly from the beginning of last week. First of all, we start the week with Powell's speech, and during the Q&A session, I saw a positive outlook for the stock market, because he said if the non-farm payroll number was not announced at that time, because it was on last Monday and the non-farm payroll was on last Friday. So he said that if they see worsening in non-farm payroll numbers, rate cuts will be brought forward, and if they don't, rate cuts will continue until they reach the neutral rate. And companies, with that mentality, the companies' earnings wouldn't deteriorate, because in any case there are upcoming rate cuts. So after this, for sure, the stock market perceived it positively. It was important that he also mentioned the upward revision in the GDI, gross domestic income measure, and the savings rate. Apparently, they don't want to disrupt the labor market. That's their priority right now. Then on Tuesday, we received ISM Manufacturing and JOLTS job openings data. So the ISM Manufacturing data for September came in below market expectation, remaining the same as in August. While new orders have slightly recovered, they are still clearly in the contraction territory. There was a sharp pullback in the employment subcomponent, which was significant for the non-farm payroll data. So issues in the manufacturing sector persist, seems like that, but there was an increase in JOLTS job openings. If we only look at this number, 25 basis point rate cut in November seems reasonable, as job openings if increase but the thing is the data shows something. When you get in the deeper, when you get into deep, you show that the data shows signs in labor market weakness, with lower quit rates and fewer job openings and reducing higher. Then we received the September ADP employment data, which came in 143K. It surpassed the market expectation, which is also positive data for labor market. The job creators were mainly mid and large size companies. The wage increase for those staying in their jobs was 4.7%, and the wage increase for job switchers was a 6.6%, and the wage growth for job switchers saw a sharp decline from 7.3% last month. This is also a positive for the fact the headline numbers showed some recovery, and the decline in wage-driven inflation risk is positive for the stock market as well. The data supported again 25 basis point rate cut in November, but for sure NFP was the important one. I'm explaining all this data up until, because I want to show you how we converge to the NFP data, in what state the stock market, the markets in general, got close, converged to the non-farm payroll data. Then we received ISM service data. The data set was much better than they expected, and aligned with the soft landing scenario. Just as a reminder, as long as we see a good data, that means currently good pricing in let's say risk on assets, and that is also leads to a soft landing. That's the main mentality. This ISM service data also supported 25 basis point rate cut in November. The headline figure was 54.9. and the new orders subcomponent saw a strong increase, reaching like a 59.4, and like after this data also with a decline in 50 basis point rate cut probabilities, we saw that yields gain upside momentum on Thursday after the data. Then on Friday we came to the NFP day. The data set was much better than expected, as well as like other data sets that we received along the week. After this data set, the base case for the Fed in November was a 25 basis point cut. Also, I was reading a JP Morgan report today. They also believe that like this 100 basis point total, like this from September until the end of the year scenario would be the best scenario according to them as well. So this NFP also supports the 25 basis point rate cut scenario. The headline figure was well above the median expectation of 150K, and even exceeded the highest estimate of 220K. Another important measure, that 3-month average for the headline rose to like 186K. That's another important part. The last month was like 140K, and the private sector's 3 months average increased to 145K. There was also a plus 72K revision for the past 2 months. As you might recall, that I was mentioning a lot about like downside revisions that were coming to the like non-farm payroll data in like previous months, but this time like the opposite happened, and like an upward revision came to the last month. That's really important, I think, and the unemployment rate fell from like 4.2 to 4.1%. The participation rate remained unchanged. Also, another important data that we were looking carefully was average hourly earnings data. Currently, it's like it's not that important compared to labor market, as the main focus is like labor market right now. But average hourly wages were revised upwards for August in both like a monthly and annual terms, and they were above expectations for September. As I mentioned, like if inflation were to focus, I would give. That would be much more important. So overall, like to wrap up, where are we right now? What's going on? Like starting from Powell's speech until the NFP numbers, all aligning this week, like last week, and signaling 25 basis point rate cut in November meeting, and signaling a soft landing. However, despite these positive numbers, like concerns remain over rising households debt, like higher delinquency rates, and increasing credit card interest rates, which suggest economic challenges for many consumers, in addition to labor market weakness with lower quit rates, fewer job openings, and reduced hirings from JOLTS job openings number. The divergence between the labor market indicators, like weakness in JOLTS and strength in NFP, and like a broader economic growth, is making a bit difficult to clearly signal whether the economy is cooling or in more serious danger of like maybe crashing. That's in that terms, it's a bit difficult market to manage right now, because like some details showing some that we need to be cautious, but on the other hand, like the headline numbers coming like signaling soft landing. Like as a result of all this like data flow from the beginning of the week, we saw that good data, good pricing idea, like that narrative, that mentality persistent, and US indices remained positive a bit. I mean, we saw some like tumbling, but like at least like they managed to remain positive. And currently, while I'm recording this video, it was up, and yields have gone up with the expectation that 25 basis point is highly much probable than 50 basis point rate cut. Naturally, we saw like USD dollar index moved to towards 102 levels, which put some pressure on precious metals, but it didn't lead to like a huge sell-off. Still, I remain like I keep like that mentality of being long in any kind of correction in precious metals. I still see more upsides for cryptos compared to downsides. Even like the likelihood of 25 basis point rate cut is the base scenario. At least I don't see any like a very strong like downside scenario for cryptos. And the situation for like oil is really tied on ongoing geopolitical developments. But the thing is, from OPEC plus geopolitical tensions, these are two factors that support oil prices. But apart from that, if like also like China is another issue. There was like a monetary side stimulus came in, but the fiscal package today announced like it didn't. It didn't satisfy the market. It's like the market was expecting much more fiscal stimulus from Chinese Chinese government, but it didn't happen. That lead to some like a significant decline in indices on China, and like considering this like general like growth issues persist. I don't know like what would drive oil higher apart from geopolitical tensions. So let me just review a few charts with you to understand like to where are we. First of all, I'd like to start with long-term treasuries ETF. This ETF means like if this goes up, that means yields are coming down. So as we are on the path of rate cuts, we expect this to go up. And I was looking like technically, is there any sign for it? And as you can see here, really nice like bottom reversal ascending triangle chart pattern is being formed. And this like it's a weekly chart, and this red line is 40-week moving average. And around this area, we might see some rejection, and this upside trend might continue. Started from like rate cuts. I mean, that's how I'm following rates for the like a long term. But the other day, like I think I was reading the UBS report, and they were mentioning that the downside room for like higher long-term yields is much like a lower compared to the short term. That's why if you don't want to be like if you want to be short on yields, that means long in treasuries. But if you want to pick rather than long-term yields, you can go to short-term ETF bond. This is called SHY, and this is how I'm monitoring this one. As you can see with this, after the non-farm payroll data, with 25 basis points rate cut being the base scenario, we saw this weekly move. But if you take this as like a fake breakout, you might expect this price action to continue if you want to be short on yields. So let me show you how I'm following dollar index. Here, as you can see, this was the one I keep mentioning, and this symmetrical triangle chart pattern breakdown, pulling back right now. That's why this like 102.5 levels, this region will be so important. That's I'll be following closely. If we see a rejection, that will be like a natural move in terms of like technical perspective. So today I'll show you this. I'll try to show you the sentiment through indices, and I think there's a theme lying under this. I'll show you a little like divergence. First of all, as long as we're just above like, I don't know, like 5,700, 5,650 levels, as long as this old resistance, current support level is protected, I think like S&P index is like still this breakout is valid, and this is like a daily chart, and as you can see, like 21-day moving average is still carrying, and I still don't see any threat on it. And when you go to, just before this, I'd like to show you NDX Nasdaq. As you can see here, this was another important one. 2, 3 breakout, and it failed to move, unlike S&P 500. When S&P is outperforming Nasdaq, that I think signals sector rotation, because S&P is much more broad-based. It consists much broad-based sectors and stuff, and in that terms, like we can say that I think it was like 2 months ago, in the beginning of September, the sector rotation, we had some videos about that. Sector rotation had begun. I think what I'll be looking for is maybe. I mean, I don't see any reason to be short in stock market yet, but maybe being defensive much could be better. That means rather than rather than getting into a more technology-based growth stocks, maybe defensive sectors like consumer staples, utilities kind of sectors might perform well. That's the divergence that I would like to see. That's why, accordingly, I'll show you Russell 2000 index. As you can see here, there was in the weekly chart, that was a really nice rectangle chart pattern triangle. It's broken out, but it didn't manage to go continue. But here, as you can see, an HNS head and shoulder continuation chart pattern might be formed if we see the continuation. So as you can see, there's at least there's at least a narrative for Russell 2000. But as you can see, when you go to the Nasdaq, you can see that after this breakout, it failed to move further. And I don't know, still 21-day moving averages is holding. But as long as we couldn't get rid of this a support level of, I don't know, 20K or 9,900K, that range, I'll be a bit cautious on tech stocks or a large cap. I don't want to say a large cap, but more a growth tech, Nasdaq based stocks. And yeah, Europe side, Stoxx 600, that's how I'm following this one. I think there's an head and shoulder continuation chart pattern is formed, and a 50-day moving average is still holding, and still I think this, as long as we're above this 50-day moving averages, still it's probable that this price acts like that. And DAX, same here. I think it's pretty important. Resistance level is broken out and a pulling back right now. I'm watching it if it's managed to hold above 21-day moving average and this resistance, which correspond to the same level, as you can see. And maybe a trade idea is being long around here with a tight stop might work in DAX. And lastly, I would like to show you QQQ. This ETF is more technological, kind of. It's kind of a reflection of Nasdaq. I just wanted to show this in order to show you that divergence between. This, I think, broad-based good stock market scenario, much probable than just at least we're gonna see some convergence between that tech stocks and the rest of the market. And I think this QQQ NDX versus SPX and Russell 2000 the divergence in technical side shows this broad-based market price actions. And yeah, that's all I'm gonna talk about this week. Hope you find this video helpful, and if you find it helpful, please subscribe, and please give if you have any comment, if you have any question, please ask in the comments on the video. And thank you for watching. Have a good one.